So friends, now we will discuss about the deficits. So we already discussed about various components of the budget, especially the capital items and the revenue items. We discussed about the receipts and the expenditure both, right? Now we will discuss about the deficits. So let us start. First of all, what is the meaning of deficit? Deficit simply means shortfall. It simply means shortfall. Shortfall, that is, whenever there is a situation where expenditure is more than the receipt, right? So deficit means shortfall, and shortfall of what? Shortfall of receipt as compared to the expenditure. This is deficit. Now in case of government finances, there are various kinds of deficit. What are those kind of deficit? So the first deficit is budget deficit. So budget deficit, basically it can happen where expenditure, that is a total budget expenditure, is more than total budget receipts, right? However, practically this situation is not possible, because always total budget expenditure is equal to total budget receipts. Why this? Because if 1000 rupees is the expenditure of the government, and from its own resources government is able to arrange 900 rupees, to meet the expenditure of 1000 rupees, it will take 100 rupees from some other source, like it can raise the loan. So total receipt becomes 1000. So total expenditure and total receipt will always be equal, because unless and until we have the receipt equal to expenditure, the expenditure cannot be met. So budget, in case of the deficit, in case of budget deficit, is always zero. It is always zero. So this is the first kind of deficit. The second kind of deficit, is revenue deficit. Now, what is the meaning of revenue deficit? When revenue expenditure is more than revenue receipt. So for example, the expenditure is 100 rupees and revenue receipt is 90 rupees. So we have the deficit of 10 rupees, right? So we have the deficit of 10 rupees. Reverse is also possible. That means there is a possibility of revenue surplus also, although practically this does not happen. So why this does not happen? Because government is not a profit making entity. Government is a welfare entity. So government cannot earn the profit. So there is never a situation of revenue surplus in the normal case of operation, right? So revenue surplus basically means when revenue receipts are more than revenue expenditure. When revenue receipts are more than revenue expenditure. So this is the meaning of revenue surplus. Now, whether revenue deficit is desirable or not, revenue deficit is not desirable at all. Why? Because revenue deficit basically represents that we are making the revenue expenditure, even if the revenue receipt is insufficient. Now, what is the meaning of revenue expenditure? Revenue expenditure means those expenditure which are incurred for day-to-day operation. for running the government, salaries of the government, interest, subsidy, the defense expenditure. So when the day-to-day operations of the government, the cost of those operations is more than the day-to-day receipts of the government, that means government is actually using the money from some borrowing. So government is actually borrowing, government is taking the loan for its day-to-day operation, which is not a good scenario. So if the government is borrowing even for its consumption expenditure, for day-to-day consumption, it is completely undesirable, right? Now, how much revenue deficit is desirable? 0%. So ideally the revenue deficit should be 0%. However, normally this revenue deficit hovers around 1% in India. So actually revenue deficit is around 1% in India, but ideally it should be 0, right? Ideally it should be 0. So there are certain provisions of the FRBM Act also. FRBM means Fiscal Responsibility and Budget Management Act. What is that? So FRBM Act is basically one of the tool where Parliament exercises the control over the government by setting the upper limit over the deficit, right? So basically deficit means expenditure is more than revenue, which is not a desirable situation, and Parliament is the ultimate custodian of the government finances. So Parliament has laid down one law, that is Fiscal Responsibility and Budget Management Act 2003 or FRBM Act 2003. In that law, it has set out some upper limit, that if any deficit goes above this limit, then central government has to give the explanation. So it sets out the accountability of the central government. Now coming back to the revenue deficit, in case of revenue deficit, the original FRBM Act in 2003, it said that till 2008-9, the revenue deficit should be 0%. And every year from 2003 to 2008-9, the revenue deficit should be decreased by 0.5% of GDP. Right? So 0.5% of GDP reduction should happen every year from 2003 to 2008-9. But actually in 2008-9 revenue deficit did not come to 0. Rather it increased to more than 1%. Why? Because in 2008-9 there was a global slowdown going on because of the subprime crisis which happened in USA. Right? So in USA there was huge economic slowdown which penetrated to all over the world, and India was also impacted. So in that situation, government has to spend huge money so that the economy keep running. So at that point of time, the revenue expenditure could not be controlled. Because revenue expenditure could not be controlled, so revenue deficit could also not be controlled. So the limitation of 0%, which was set out in the FRBM Act 2003, was missed. Ultimately, we again revised these limits again and again in 2018 as per the recommendation of Encasing Committee. Right? So one committee was set up to review the FRBM Act, and that committee had some recommendations. Finally, the committee recommended that till 2022-23, the revenue deficit should be 0.8% of GDP. The revenue deficit should be 0.8% of GDP. It was a recommendation of the Encasing Committee. However, the government did not adopted the recommendation. Government did not include that provision in the FRBM Act, revised FRBM Act. Although in the budgetary documents, in the other government discussions, the government said that okay, we will try to maintain 0.8% of GDP revenue deficit by 22-23, but in formal document the government did not include this revenue deficit limit, right? So this is all about the revenue deficit. Now there is one more term which is effective revenue deficit. So what is effective revenue deficit? So first of all, let us see revenue deficit again. So revenue deficit means there is excess of revenue expenditure, right? Now inside the revenue expenditure we also include one item called grants to the states. I hope you remember. So I discussed this point separately when I was discussing the revenue expenditure. So grants to the state means it's a kind of donation, it's a kind of assistance, it's a kind of gift which is given by the central government to the state government, and this grant is given. So what irrespective of the ultimate use by the state government, so whether the ultimate use is done for the revenue expenditure purpose or for the capital creation purpose, irrespective of what is the purpose for which state government is actually using this money, irrespective of all that, this is classified as the revenue expenditure in the books of central government. In the books of central government it will be classified only and only as the revenue expenditure. Why? Because it is a grant, it is the expenditure from the side of central government. So out of this money, if state government is utilizing some amount for the creation of capital assets, for example, it spends rupees 100 crore for the road construction, right? So even this is part of the revenue expenditure in the books of central government. So this 100 crore government road construction expenditure, for the state government this is capital expenditure, and for the central government this is revenue expenditure, right? Now when we are calculating the deficit in the simple revenue deficit, in the revenue deficit, this grant to the state for the creation of capital asset, it is already included in the revenue deficit. This revenue deficit is not representing the true picture, because this grant for the creation of capital asset is actually creating some kind of capital asset in the country, right? However, if we just see the revenue deficit, we will say that revenue deficit is basically revenue expenditure, right? But actually at the state level it had we have created some asset. On the face we are saying revenue deficit is consumption expenditure for day-to-day operation, but actually out of this expenditure only we have created one asset in the state, right? So if we go beyond the technical things, if we go beyond the legal things, on the face it is very clear that this capital which has been created in the state, the expenditure incurred on this item should not be included in the revenue deficit. So logically this revenue deficit should be adjusted for the grant given to the state for the capital asset, and this is exactly what is done in the effective revenue deficit. So for calculation of effective revenue deficit, we reduce the grant to the state for the capital asset out of the revenue deficit. So this is how we calculate the effective revenue deficit. So for example, the revenue deficit is 1000 crore rupees. Out of this, the grant given to the state for the capital asset creation is 100 crore rupees. So 900 crore rupees is the effective revenue deficit, right? So this 900 crore is representing that this is the consumption expenditure which is in excess of the revenue receipt. So this gives the true picture rather than the revenue deficit. This concept was actually introduced in the 2011-12 for the first time. Now, the next term is fiscal deficit, right? Fiscal deficit. Fiscal basically means the government treasury, right? So fiscal deficit is basically the overall deficit, overall shortfall of money, right? So there are various kind of receipts and various kind of expenditure. How do we calculate the fiscal deficit? From the total expenditure, we reduce the revenue receipts and the non-debt capital receipts. Right? So total expenditure includes both the revenue expenditure and capital expenditure, right? So total expenditure includes both revenue expenditure and capital expenditure. Out of the total expenditure, we reduce the revenue receipt plus the non-debt capital receipts. So when we reduce the revenue receipt and the non-debt capital receipt from the total expenditure, what we get is basically the debt receipts of the central government. So fiscal deficit is nothing but the debt receipts. It is nothing but the debt receipt. That means it includes, debt receipt basically includes the borrowings and other liabilities. The borrowing include both internal and external borrowing. Other liabilities include a small saving scheme, provident fund, etc. Right? So this fiscal deficit basically means the total debt taken by the government in the current year for meeting its total expenditure. Right? This debt can be used for either revenue purpose or capital purpose. So expenditure out of this receipt can be either revenue or capital. It does not matter. But what is important is that fiscal deficit is basically the total debt receipts, right? So again for your simplicity, if we see the total receipts, if we see the total receipts of the government, the receipt part of the government, there are two kinds of receipt: revenue receipt and capital receipt. In the capital receipt, again we classify capital receipt into debt receipts and non-debt receipts, right? So in fact debt receipts are further classified into borrowings and other liabilities. Other liabilities means the items other than borrowing which are part of the debt. So fiscal deficit is this portion only. So this portion actually reflects the fiscal deficit. So this basically reflects that this is the shortage of funds to meet the expenditure of the government, and this amount the government has taken the loan for meeting its overall expenditure, right? This debt can either be utilized for the revenue purpose or for the capital purpose. Now there is a question, how much fiscal deficit is desirable? So economists believe that 3% of GDP is desirable. That means we can easily incur 3% extra expenditure and take the loan of 3%. But please be careful what I'm saying. But this 3% should be utilized for the capital expenditure purposes. So 3% of GDP can be the fiscal deficit, but this must be utilized for the capital expenditure. Capital expenditure means assets creation. This 3% should not be utilized for the revenue purposes. This should not be utilized for the revenue purposes. This should be utilized only and only for the capital purposes, right? So this fiscal deficit target should be 3%. The original FRBM Act 2003 it also laid down the upper limit of 3% till 2008-9. In actual, it was not achieved. Again, Encasing committee came. Encasing committee recommended that fiscal deficit should be 2.5%. The government has adopted that recommendation, and the government has said that okay, we will try to achieve the target by 2022-23. Right? We will try. So this is the fiscal deficit. Now there are some more terms associated with the fiscal deficit. One term is the gross fiscal deficit, and the net fiscal deficit. So what is the difference between the gross revenue deficit and the net fiscal deficit? So gross fiscal deficit is the normal fiscal deficit that we just discussed. That means the total debt receipts, right? The total debt receipts. Now net fiscal deficit is basically the gross fiscal deficit minus the net lendings by the central government. Now what is this? Let us understand. So we have whatever loan we have, the central government has taken. Suppose central government has taken the loan of 1000 crore rupees. Rather, we should take different figure, 2000 crore rupees. The central government took the total debt receipt of 2000 crore rupees. So this is the fiscal deficit. But out of the 2000 crore rupees, it actually gave some loan of 500 crore rupees to the state government or some other public government agencies. Suppose it gave the loan of 500 crore rupees to the other agencies. So this, out of 2000 crore it has taken, 500 crore rupees has been given as the further loan. So actually only 1500 has been utilized by the central government for its own purposes. So this is the correct picture of the fiscal deficit. So net fiscal deficit is more appropriate. It is much more appropriate, right? So this is the difference between the gross fiscal deficit and the net fiscal deficit. There is next deficit, that is deficit number 5, primary deficit. What is primary deficit? So we have fiscal deficit, right? So fiscal deficit represents all the debt receipts, the loan that we have taken. So this debt, we out of this debt we must have paid some interest expenditure. This interest expenditure basically represents the interest expenditure on the loan that we took in the earlier years. The loan was taken by the previous governments. Suppose we talk about the Modi government. Before the Modi government we had the UPA government, right? So the loan was taken by the UPA government, and the Modi government is actually paying the interest expenditure on those loans. Now if we want to judge the performance of the Modi government in the current year, current year, only and only current year, let us suppose for example year 2020-21. So we actually should eliminate this interest expenditure which we have paid out of the total debt receipts. So suppose the fiscal deficit is 2000 crore rupees. From the fiscal deficit we will reduce this interest payment done by the government. Suppose interest payment is 200 crore rupees. So 1800 crore rupees is the correct figure, which actually shows that in the current year the government has taken the loan of 1800 crore for meeting its current year expenditure. This 200 crore expenditure was for the previous years. This was unavoidable. The current government could not have done anything about it, right? This was unavoidable. This was without, not in the control of the present government. Therefore, this should be eliminated, because this 200 actually shows the poor performance of the earlier years. It has nothing to do with the current government. Therefore, it is completely eliminated, and what we receive is the primary deficit. So this is the primary deficit. And I would like to discuss one more concept, that is the deficit versus debt. Please understand this thing very carefully. This session is going to be very, very conceptual and very, very interesting. You will receive a lot of information which you can actually utilize in the newspaper reading also. So your newspaper reading will become very, very beautiful after completing this session. Deficit versus debt. So deficit versus debt. What is deficit? Deficit is very, very simple. The borrowing of current year, right? In fact, I should say fiscal deficit versus the public debt. So either you can say simple deficit versus debt, or you can say fiscal deficit versus the public debt, right? So this fiscal deficit represents borrowing of the current year, and normally the limit capped is 3% of GDP, right? So this represents how much loan we have taken for the expenditure of the current year. Now, what is public debt? Public debt is the accumulated debt or accumulated borrowings of the government. Accumulated borrowings, right? So this 3% shows the current year, only 1 year, right? And this accumulated borrowing shows all the years, right? All the years including the current years. So suppose we had 1% of GDP, 2% of GDP, plus so on and so forth. So for the last so many years till now, how much borrowing we have actually done, including all the interest that we have to be paid, right? So borrowing include the loan that we took and the interest which is yet to be paid on this borrowing till that current year. So the total borrowing plus the total interest, when we combine both, this is basically public debt, right? So fiscal deficit is actually the current year figure, and public debt is actually the total figure till the current year. So there is a concept of flow versus stock in the economy. This fiscal deficit actually shows the concept of flow, and this public debt actually shows the concept of stock. What is the concept of flow and what is the concept of stock? Flow basically means between two dates. So this fiscal deficit represents the figure between the start of the year, that is the 1st April, and end of the year, that is 31st March. So this shows figure of 1 year between two dates, and this stock concept shows the figure till a date. So can we say till 31st of March 21? Here we can say from 1st April 20 to 31st March 21. So here it shows the duration, it shows the point of time, the borrowing done between this date to this date. Here we say the borrowing done till this date. So flow concept is for a duration and stock concept is till a point of time. This is the difference between the flow and the stock concept. So fiscal deficit is a flow concept and public debt is a stock concept. This concept is very, very important to understand, because normally when we read the newspaper, we actually forget this part and we keep struggling between what is the difference between the fiscal deficit and the public debt. Next question I want to address is that what are the adverse impacts of fiscal deficit? What are the adverse effects of the fiscal deficit? if we talk about the adverse impacts, the first adverse impact is that it creates the burden for future generations. Why? Because fiscal deficit basically represents the loan that we have taken, the loan that government has taken. When we have taken the loan right now, this has to be repaid in future. So in future, this will be repaid. Now for the repayment, the government will have to receive some amount, right? Government has to receive this amount. This receipt can happen either from the revenue receipt or from the capital receipt. In the revenue receipt, it can happen either from the tax revenue or non-tax revenue. In the capital receipt, it can happen either from the debt or non-debt. Right? Now let us see. This revenue, non-tax revenue, this has very, very low chances to get improved. We cannot increase this non-tax revenue suddenly, right? Because this majorly represents the user charges. So government cannot increase the user charges suddenly. Non-debt receipt, for example, disinvestment, repayment receipts, that also we cannot increase suddenly. That is not in our control, not in the control of the central government. If we take the debt, this is not desirable because we want the money to repay the loan. If for repayment of the loan we again take the loan, this will mean that we are in the debt trap. That even for paying the loan, we are taking another loan. So virtually we are not repaying the loan. Virtually we are just changing the source of the loan. So this is also not desirable. What is the ultimate impact is actually upon the taxes. So ultimate burden is borne by the taxes only. That means the tax rates have to be increased, and when the tax rate will be increased, who will be under the burden? It will be the common citizen. The future generation, our children, will bear the brunt of the loan that we are taking right now. That is why this is called that this loan that we are taking right now is not a good thing, because ultimately our children will have to pay in the form of high rates of taxes. If they have to pay high taxes, this is not a good condition. This is not a desirable situation. That is why we say it is the burden for the future generation, right? So this is the first impact. What is the second impact? What is the second impact? The second impact is that it will lead to inflation. Why inflation? Because when government take the loan, and this loan is actually used for government expenditure only, that means it will go into the economy. It will increase the money supply. When money supply is increased, it means the government, the people's purchasing power will increase. When purchasing power of the people increase, that means the demand of the goods will increase. If the demand increases, and supply cannot increase suddenly. Please keep in mind, supply cannot increase suddenly. If the demand increases but supply do not increase suddenly, that will actually lead to the price rise. And this price rise is nothing but the inflation. So you can see clearly that how the fiscal deficit is actually leading to the price rise and the situation of inflation. This is the second impact. Third impact is upon the private sector investment. This is called crowding out of private investments. Crowding out of the private investment. What is this? So when government is borrowing from the domestic sources or from any source, that means suppose in the market there is availability of the 1000 crore rupees funds. This fund is available both for the government and the private sector. When government takes more loan, when the loan of the government is increased, that means the private sector's loan taking, the resources available for private sector are reduced, right? When loan facility for the private sector is reduced, then they cannot invest into the economy. If they cannot invest into the economy, that actually brings down the level of investment, that reduces the productive capacity, that reduces the GDP. So this crowding out of the private investment is an next impact. So total three impacts. First impact is what? First impact is burden on the future generation. Second impact is inflation, and third impact is crowding out of the private investment. These are the adverse impact of the fiscal deficit. Therefore, we should maintain the fiscal deficit within the range, and we should try that fiscal deficit is actually used for the capital purposes, right? So there is a golden rule of fiscal deficit. What is that golden rule? So golden rule says that fiscal deficit should be used only for capital expenditure, right? So fiscal deficit basically includes the revenue deficit also. Fiscal deficit includes the revenue deficit, right? How is that? Because fiscal deficit represents total borrowing. This borrowing can be used for the capital purposes and for the revenue purposes. The borrowing which have been used to finance the revenue deficit, that is revenue deficit only, right? So the fiscal deficit is including the revenue deficit. If suppose fiscal deficit is 3% and revenue deficit is 1%, that means only 2% of the GDP has been used for the capital purposes. What is the golden rule? Golden rule says that revenue deficit should be 0%, so that this total 3% can be utilized for the capital purposes. I hope the concept is very, very clear to you. So very simple, that capital purpose should be the prime focus of the fiscal deficit, right? There is one more deficit, the last one, which is monetized deficit. What is monetized deficit? Monetized deficit is how much money we are receiving from RBI to meet the deficit. So this can either be in the form of borrowing from the RBI or withdrawal of cash balance. Balance from RBI. Withdrawal is also called as drawdown, right? So it can either be a borrowing or it can be withdrawal of cash balance. Borrowing, that is the government is taking loan from its own bank, central bank, right? So central bank or RBI is the bank of the central government. So central government is taking loan from the RBI. This is the first thing. Or it is withdrawing its own cash balance from its own account, which is lying with the RBI, right? So RBI is the bank of the central government. So central government is withdrawing the cash from the RBI. So ultimately any amount which is taken from the RBI for managing the deficit, that is monetized deficit. That is monetized deficit. There is one more term which is deficit financing. Deficit financing means what are the sources from where deficit is financed. Very simple, right? What are the sources? So what can be the sources? So sources can be all debt receipts. right? So debt receipts can be either in the form of borrowing or other liabilities. Borrowings can be either internal or can be from external, which is called external debt, right? Other liabilities, it can be in the form of small savings schemes. Securities issued against small savings can be in the form of public provident fund and so on, right? So deficit financing means how we are sourcing the financing, the deficit from different sources, how much money we are taking from external, how much money from small saving, how much from this, how much from that. So when we see the figures in that budget and the economic survey, that how much is the contribution of each of them, so that is actually the deficit financing. So deficit financing is basically the sources or the process of financing the deficit. Now we are going to this, we are just looking into our study material, and in this material you can see I have discussed budget deficit, revenue deficit, effective revenue deficit, fiscal deficit, primary deficit, and negative impacts of high fiscal deficit, how much fiscal deficit is reasonable, gross fiscal deficit, net fiscal deficit, golden rule of fiscal policy, right? Now coming to this medium term fiscal policy statement. So this medium term fiscal policy statement is actually given by the government as part of the budget, right? And this is as per the FRBM Act. So I already told you that we have the FRBM Act. So this medium term fiscal policy statement is as per the FRBM Act. Now this statement gives different projections of the government. So for the 2018-19, if we talk about fiscal deficit is 3.4% of the GDP. This is as a percentage of GDP. For 1920 budget estimate, the original budget estimate was 3.3%. 2021 the estimate was 3%, and 2021-22 this was again 3%, right? So we aimed at bringing it to 3% by 21-22. For the primary deficit, this was below 0.5%, you can see. So primary deficit is very, very low. That means most of the fiscal deficit is for paying the interest liabilities of the earlier years only. That is a good thing. Revenue deficit is very, very high. So in 18-19, 2.2, 2.3, 1.9, 1.7. So you can see it is more than 1.5% consistently. Central government debt. So this is basically public debt. This is called public debt or central government debt. As a percentage of GDP, it was 48.4% for 18-19, 48. So you can see this is closer to 50%, and here it is coming to around 45%. As per the encaissing committee, this central government debt should be reduced to 40% of GDP. So our target is 40% of GDP. Here you can see the deficit trends, the actual figures, right? So actual figures you can see. Fiscal deficit for 18-19 is 3.4%. Budget estimate for 1920 was 3.3%. So we estimated that we will keep 3.3%. In 1920, the revised estimate, this revised estimate was given on 1st of February 20 in the budget of 2021. So on this date, we revised this estimate, and the finance minister said that this will be 3.8% because the current year there has been a slowdown, cyclical slowdown, and after the budget announcement itself, there is this coronavirus related slowdown. So there is a very, very high chances that even this 3.8% fiscal deficit will exceed. It will go more than 8%. And we estimated that we will maintain 3.5% for the 2021, which is going to be much more higher because of this coronavirus slowdown. Revenue deficit for the current year we expected 2.3, but we increased to 2.4, then 2.7. This can go up to 3%. So we are really in a very bad situation nowadays. Effective revenue deficit, it also going up. Primary deficit, it is also going up. You don't need to remember each and every figure, just remember this fiscal deficit and the revenue deficit, especially these two figures. So we are targeting 3.8% and 2.8%. Deficit financing. Deficit financing refers to the methods through which budgetary gap is financed. Deficit financing can be undertaken by the government by borrowing from the RBI and creating fresh currency or running down its accumulated cash balance. Effect of deficit financing is that it can increase to prices. So all the effects of fiscal deficit, that is inflation, etc., all these are the adverse impacts of the fiscal deficit financing. You can see these are the different sources of deficit financing. We have this net marketing borrowing, state provident fund, external debt, securities against small savings, other receipts, drawdown of cash balance, and out of this the maximum amount is withdrawn from the securities against small savings. So you can see this line, and then second highest is from the other receipts, internal debts and public accounts, right? And this yellow indicates state provident funds and red indicates the external balance, and this is negative. So this is basically the drawdown of cash balance. That means we have actually not withdrawn, rather we have deposited the money with the RBI, right?